Hello and welcome to Livewise Buy Hold Sell. I'm Ali Selby and today we're talking hardcore growth. This episode is for younger investors with longer time horizons or those who have a higher risk tolerance. Today we're going to be talking about stocks that can deliver compelling returns above the long-term market average, and to do that we're joined by Nick Sladen from LSN Capital and Adrian from Elvest. Okay, let's dive straight in. What's the best advantage a growth investor can have? Nick, I might start with you.
Well, looking long term, time enables you to look through half yearly and quarterly reporting cycles and focus on what the long-term total addressable opportunity is for these businesses. You know, there's been several examples over the last 20 years of some of the best companies like REA, Seek and Car Sales, where at certain points in time they've had hiccups on their cycle, but the long-term total addressable market has remained intact and all of those businesses have disrupted incumbents and done really well.
Everyone's really focused on reporting season numbers right now, whether they are half yearly or full year numbers. Why is it important to look longer term, particularly for growth investors?
We think it's particularly important for all investors. If we look at the old saying that time is the friend of the wonderful business, we certainly agree, and it's particularly apparent for those companies that have an ability to reinvest and compound at very high rates of return. We tend to think that time will be the best friend of those companies that can self-fund their way into very deep pools of opportunity. So if you think about the likes of Mineral Resources, Nick Scali, Technology One, Premier Investments, it's quite a long list of good quality founder-led type companies that certainly appreciate the importance of this characteristic, and they've all been multi-baggers over the past decade plus. So that illustrates the power of compounding, particularly when executed over long periods of time.
Okay, I want to know how you would invest if you weren't being judged on monthly performance figures, if you were being judged on, I guess, that kind of longer term.
It's a great question. I think there's always a lot of noise in markets, but there's always opportunities too. As bottom-up stock pickers, we spend most of our time really focusing on business quality and those companies with longer dated earnings drivers. So for that reason, I really wouldn't change much about our process. It's very much geared towards finding those companies that have a competitive advantage, that can reinvest into long-dated opportunities.
Are there any sectors or themes you'd like to call out there?
Well, I think there's a whole range of really interesting dynamics and thematics, I guess, looking ahead. So things like digitisation, the ageing population and healthcare, infrastructure spending, and of course the green energy transition. They're all immense opportunities for investors looking out over the next decade.
Okay, over to you, Nick. How would you invest if you weren't being judged on those monthly performance figures? And where are you seeing the most opportunity for growth right now? In what themes or sectors?
Focusing on the fundamentals is absolutely critical, and looking at the total addressable market opportunity for each of those particular companies. So the areas of focus for us are how these businesses are going to get from where they are today to the opportunity in the future. So areas like AI and financial disruption, like we saw with Afterpay a few years ago, is a big example of those areas. We're also seeing emerging industries such as obviously lithium and EV, which has grown exponentially over the last few years. You've got best-in-class operators taking share from other businesses like Premier Investments, or you've got newer businesses like Netwealth and Hub doing things in really good shape and taking share also from legacy players. So we look at all those as really, really attractive options, but equally, not discounting that, some of the cyclical sectors also can be attractive at certain points in the cycle. You just need to have a really clear understanding of where you are in the cycle and what valuation looks like for some of those businesses, because there can be good money to be made on those investments as well. But like Adrian, return on invested capital is a big focus for us. So a lot of those really quality self-funding businesses are the ones that we think will do really well through the cycle.
I want to talk about the risks now. Growth investing is often considered more risky than maybe its value counterpart. What risks do you think investors need to be aware of today?
Inflated valuations, investment bubbles, the latest fad or trends. Some of those things are probably ones we're probably particularly cautious of at the moment. There's several examples of businesses in probably the larger cap space that have done particularly well. Afterpay is one. Some of the lithium producing and cash flow positive stocks are other ones, and they've dragged some of the smaller cap stocks along for the ride that might be, and some of those valuations got completely inflated, and there's a bunch of businesses that are still trading on the ASX today that are probably working through their existing residual capital, and there's limited prospect of self-funding going forward. So that's an area we're pretty cautious on, and that's where we would encourage others to be cautious as well.
Okay, what are the risks that you're seeing today for growth-focused investors?
I think the risks are twofold. Like Nick, we would urge investors to focus on fundamentals and really avoid investing in speculative companies that are burning cash and at the mercy of capital providers. Often these are the companies that have the exciting stories and the narrative, but in many cases lack genuine substance. At Elvest, we focus on those companies that are still early in their life cycle, but they still have established cash flows. They're well-established businesses, and we find that that's the sweet spot for us. I think the second risk really is just overpaying, and I think you can go buy a great cohort of good quality businesses, but if you're buying them on 1 or 2% earnings yields, we're not convinced that will generate good long-term returns. So it's really important just to maintain your discipline.
We asked our fund managers to bring not one, but 3 stocks that they believe can deliver exceptional above-market returns over the next decade. Nick, what have you brought for us today?
We're speaking about lifestyle communities, Hansen Technologies, and the platforms businesses, Hub and Netwealth. So Lifestyle Communities is an affordable land lease business operating out of Victoria. There's obviously a significant housing shortage across Australia at the moment, so they're very attractively positioned from that perspective. So they've got really good structural tailwinds. They currently have 7 new projects under development, which is quite a significant undertaking for them, and that is expected to deliver 50% earnings growth over the next 2 years, and we think you're only paying around 20 times earnings for that opportunity, so we see that as quite an attractive, compelling opportunity. Hansen Technologies is a back-end software billing service focused on the telco and utility sectors and communications. It's founder-led. The founder owns 17%. It has a really excellent return on capital, has really positive and strong cash flow generations. Over the last 3 years, as valuations have been inflated, they've been able to pay down their debt. They're basically net cash now. They've provided a good solid update today in terms of their outlook for FY24. Their second half of 2000 and FY23 was very good. So we're expecting they're expecting 5 to 7% organic revenue growth. We would expect more than that in terms of earnings per share growth, and given the strength of their balance sheet, we would be looking for them to make an acquisition, and multiples have come back which will complement that. So we think they can comfortably deliver 10% plus EPS growth for the next few years.
Wow, and the platforms?
The platform businesses, obviously Netwealth and Hub have grown significantly, over $20 billion across those 2 businesses and premium in terms of flows per annum. They've grown at about 40% CAGR over the last 10 years. They've gone from 1 to 1.5% in terms of market share of the platform business to over 6% in the last 5 years. They're both very, very attractively structurally growing, taking shares from some of the legacy incumbent players. And we think that the cost management that was shown in the FY23 results will position them well for current FY24, and there's been a big theme of money going off platform into term deposits over the last 12 months. We would expect that headwind to become a tailwind and drive flows over the next 12 months for those 2 businesses.
4 stocks, not 3. That's a little bit of a kicker. How about you, Adrian? What are your 3 stocks?
We actually tend to agree with Nick's comments there, particularly around the platforms and Hansen, where we've been a long-term supporter and investor there as well. Looking at our 3 stocks, the common thread, each operate in industries with supportive market structures. There's long-dated growth opportunities, and all are founder-led or have owner-manager teams in place as well. So our first stock is RPM Global. It's a leading provider of mining software, and principally it's servicing major global resource companies. We think they benefit from the mining digitisation theme. Many miners are still relatively early in terms of mining software adoption, so we think that represents a significant tailwind for RPM. Looking at recent results, albeit coming off a low base, FY23 EBITDA is forecast to triple, and we think that they continue to deliver really strong earnings growth from this point. Our second stock is Seven Group. Obviously it's a conglomerate, but most of its capital these days is deployed in industrial services, so business units like WesTrac, Boral and Coates. WesTrac we view as the jewel in the crown. It's wonderfully well positioned within its key markets. It does benefit from increasing mining volumes, and its high margin services business is leveraged to an ageing mining fleet here in Australia. Looking at Boral and Coates, they're leveraged to a $1.2 trillion pipeline over the next 5 years for work in infrastructure and construction. In aggregate, the group, they've got a good portfolio of assets, they've got long dated tailwinds and a really high quality aligned management team. So we think they continue to deliver from this point.
And your third stock, what is it?
The third stock is a little divisive, but nonetheless we like it for good reasons. We think it's corporate travel management, as the name suggests. It is involved in the management of corporate travel, and that's right across the world. I mentioned it's divisive because people tend to have strong views on the company, but looking at the numbers, by the end of FY24, it will have delivered compound annual growth in earnings of 19% over the past decade, which is a great track record. And looking at it today, it's a top 5 global player in what is a $1.5 trillion industry, and yet it still commands less than 1% global share. So we think corporate travel just has an immense opportunity to grow both organically and by acquisition, and we think for those investors that can stomach some volatility, they'll be well rewarded over the next 5 or 10 years.
Okay, well I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.